Welcome back to another episode of Default Global. I'm your host, Vid Cole, and in this episode, we have someone truly special with us, Alex Jekowsky, the CEO and co-founder of Sense. Sense is all-in-one platform helping laundromats and garment care businesses scale. Alex has led the company through incredible growth, including raising 40 million in this recent Series B round. Besides that, he is a second-time founder, and his previous company, Ulingo, was acquired by Modo Labs. I really hope you will enjoy watching this episode. So, Alex, welcome to the show.
Avid, thanks so much for having me, and excited to chat.
Yeah, did I miss anything important with that intro?
I think you covered it all. I think, and anything beyond that is probably not so important. But no, I think you covered it.
Awesome. So let's start at the beginning then. Before we dive into the tag, before we dive into the money, I'm just curious, how did you first identify the problem in the garment care industry? I know that this space isn't something you just stumbled into. It took time and maybe some research, right? So maybe can you share the moment when it clicked for you that laundry needed this transformation?
Yeah, absolutely. And my journey in this space is very similar actually to how most laundromat owners find it. In my experience, you mentioned that I had exited my last company. It was acquired about 5.5 years ago, almost 5 years ago at least. And during that acquisition process, I started, I was going to join the company as an executive and, believe very much in their business and things we could, my product and company that I'd started could do for them. But I also knew that when you become an executive somewhere, it's not the same as being a founder. You don't have the same kind of creative freedom, and it doesn't scratch the creative itch being maybe an employee and an executive somewhere than when you get to really build. And so knowing that going into it, I started thinking, okay, well, how do I scratch that creative itch? What is that going to be for me? And I thought maybe small business ownership was a way of doing it. And I was particularly interested in maybe opening a bar or a restaurant. I had this idea for like a Harry Potter themed bar that when I was living in San Francisco at the time, I was very excited about. But I had spoken to enough people as I got that idea and had thought and had heard enough kind of horror stories of people's experience in hospitality where I was like, okay, maybe this isn't the passion fun project that I imagined it to be. And so I started kind of thinking, okay, maybe that's not the right path for me today. At one point, maybe hopefully one day. And I, had by happenstance had met somebody. I told them about, alternative investing, and I was interested in kind of the SMB, small, medium-sized business asset class. And he mentioned that his neighbor at his lake house in Massachusetts was the former president of the New England Coin Laundry Association and had made a killing owning 4 laundromats in the outside Boston. And he said, you should look at laundromats. Like maybe I hear they're great businesses. And I was like, that's the weirdest thing I've ever heard. Who owns laundromats? I mean, I had my only experience in laundry is that I hated doing it. And I've used laundromats and shared laundry facilities in college and where I was living in San Francisco in my apartment building. But I never thought of it as like a business. But I like not just the unsexy or the boring. I like industries that are really nuanced, unique, and you get really deep into them that have their own intricacies. I found that to be the case in higher education, which is particularly in the payments and technology side of higher ed, that I loved getting really deep into that space and that business and going to the National Association of Student Affairs Professionals conferences and the EdTech CIO conferences. Like these are all just really interesting things, intellectually stimulating while also being able to be creative within those verticals. So I ended up going to the Golden State Chapter Gala at this chain Mexican restaurant in the East Bay for the Coin Laundry Association. I heard the president of the CLA talk about opportunity zone investing and the tax benefits there, bonus depreciation that happens in laundry, and the profiles of the kind of business you can have in the different revenue streams, right? There's people doing their laundry themselves, call it the self-serve business. You have the full service business, as in the counter, wash and fold, dry cleaning, the idea of the laundromat doing the laundry for you, and product sales, et cetera. You have pickup and delivery laundry, where there's a pickup and a return delivery for customers. And then there's commercial, the hotels, the coffee shops, the restaurants, the massage parlors, the gyms, the nail salons, the list goes on. So it's like, okay, there's a lot of revenue streams. You can have 30% cash flow margins or more. It's a pandemic-proof, recession-proof business. There are some interesting things on debt and real estate and on the tax side that actually can be kind of accretive and interesting from an investment perspective. And it's just durable, reliable, and it's weird. And those were all the boxes I need to kind of have checked for me. So I worked inside of laundromats. I went every weekend. People hated going around anywhere with me because if we popped by a laundromat, we were going to go inside. That was the thing. Talk to as many operators as I could. Okay. And that's when I fell in love with it. I was like, all right, I'm going to buy a couple stores and let's just see how this goes. Because there's a big multi-store ownership push, right? Over half the stores in the US are owned by multi-store owners. And that's actually even more internationally. But the average operator in what I found was owning about 2 stores. But there's a desire to own more. And what I found was, the question I asked was like, how the hell do you run these things? I've got an earnout. I've got a job. I'm not leaving. I want to own these stores. It's not passive income. I know I'm going to have to work, but hopefully not something that I buy myself a job each store I buy. And so I started looking, all right, what's the technology that's helping people scale, right? Was there a toast for laundry? Is there a square reader I can put on my washing machines and dryers? Is there, does DoorDash or Uber do delivery so I don't have to do the delivery? Who does the invoicing? For the commercial business, is there, what tools are available? And that's when I started realizing, holy crap, there's no institutional sophisticated technology company focused in this vertical. All the technology was going for the Uber for laundry and create a direct to consumer brand. It wasn't about the SMBs that are powering Main Street and really the essential business and focal point of I think a Main Street community in what they provide, in terms of like an essential service of laundry. And that's when I started thinking, well, wait a second, maybe my path is not to open stores myself, but it's actually to build technology for these store owners. And that's what kind of led me into starting Sense. We, launched in September of 2021, raised our seed round for Bessemer and off to the races from there.
In one of your podcasts, you've talked before like about this, but how the garment care industry is like a more than $60 billion market, right? That's kind of massive, but often I guess overlooked, right? So you're making it easier, from my understanding, for these businesses to operate more efficiently with Send, right? So what kind of impact does your platform have on a typical customer's bottom line? For example, maybe how much more revenue can they generate monthly using Sense compared to before, or some other metrics that you can share with us?
Yeah, I mean, look, I always say technology can only get you so far. You can have a beautiful car parked in the driveway, but at least today, Ferrari's not driving itself. You still got to get in and turn the wheel and, start the engine and drive it. But when you have great access technology, it should make the driving more fun. It should make the drive easier, and it should get you there faster, right? And so that, that's how we view technology. Is we're not saying that you can just kick your feet up and do absolutely nothing and boom, you're now making 60% more revenue and your life is infinitely easier. But but we view the business as, how do we help people grow their business, manage their business, and understand their business? Because you usually those are all really intertwined. And so we thought about our initial product was a point of sale. Now, point of sale in laundry is not like a restaurant or a coffee shop where I turn around, somebody orders a cold brew, go in the fridge, I pour the cold brew, I give it to the customer, and now that order, which took 10 seconds, is now over. And maybe I see that person tomorrow or never again. In laundry, I bring a bag of laundry that's 20 pounds and I pay $1.50 a pound, and the laundromat's going to do it for me. Now, those are my personal items, right? That could have different care preferences. My comforter might have different care preferences than my designer jeans. And I might want some things hang dried, some things folded. I might be hypoallergenic and can only have certain detergent. And I want some things to be heated differently. I want some things to be hang dried. Now, this is not rocket science. It's quite simple, but it's operationally heavy when the labor inside of stores are typically, I'd say, not super tech savvy. They can be minimum wage. It can be English as a second language at times. And so we want to actually help the tracking and quality of the wash and fold and that kind of the operations of a store to really be meaningfully easier to track and manage. So the point of sale is really the gateway for us to provide a management system so you can handle the thousands of pounds of clothes per week and all the varying preferences. And by and large, we're replacing pen and paper. And we always tell folks also, like, it's not that a laundromat can't exist without technology. They've been
Mm-hmm.
doing it for 60, 70, 100 years. They've been existing without technology. And it's a great business even without technology. But boy, what an opportunity when you can add great operating tracking
Right.
systems or take pickup and delivery. The only way to do delivery and laundry is you buy a van, hire a driver, gas, insurance, et cetera,
Mm-hmm.
because there's a pickup and a return delivery for the same order, right? So the gig economy is always going from merchant to customer, not customer to merchant and then merchant to customer.
Right.
But we built the first ever integration with Uber, DoorDash, all these different tools. And so now an operator can actually do pickup and delivery with no required capital expenditure. They can, of course, buy a van. We do fleet management, all of these things, but we're enabling operators to offer more services.
Mm-hmm.
And an average pickup and delivery order versus a counter over the counter sale is the difference between $25 over the counter and $75 on average online. So we can really help people offer more services without incurring meaningful additional cost. And then they can track and have better operations within that business. So we want to help them kind of grow, manage, and understand. Just a couple examples of parts of our business. We also convert coin operated machines to pay by card and pay by phone. And now you don't have to deal with coins. And we had somebody in a Facebook group on these laundromat owners forums post that they saw a 60% revenue increase when they installed that. So is that all the time? No, but we've seen it many, many, many times, a really meaningful revenue lift.
Yeah. Okay, so let's talk about that incredible, like a 40 million Series B round you just raised. It was in August, right? So
I announced it in August, correct?
That's huge, man. Like a 40 million, right? It brings like your total funding to over 77 million, right?
Yeah, I think about that. So 77 and a half.
77 million. Oh my God. So how does it feel like it reached that milestone, and how does this round compare to previous fundraising efforts?
Well, look, I tell every founder that I speak with that, capital raised rarely is an indicator. I don't like to use capital raised as an indicator of success or a badge of honor. If anything, it just means the outcome has to get bigger and bigger, right? And the business is moving in a venture growth capacity. And so, we raise capital, not because I like raising capital. I love our investors, but do I like dealing with investors all the time? Of course not. I like to build. I want to create product. I want to focus on our customers. So it's a means to an end for us, right? We raise capital because if I just wanted to build a POS company, I wouldn't raise $1. I'd build it over 5-10 years and have a nice lifestyle business that can make some money. But our ambition in this space is to power laundry day in America through local businesses, to really deliver a caliber, sophistication, and breadth of solutions to the lowest common denominator, the operator in rural America that just is buying a business in the American dream and working themselves and their whole family in that store, to the private equity type people are trying to buy 20, 30 stores a year if they have the capacity. And so for us to provide the optionality of technology to be able to be an all-in-one solution that's helping you with your online ordering and your in-store and your on-machine payments and your employee management and your reporting, and the list goes on. And to do that in a short time frame where we can continue to grow and provide differentiated value, it costs money, it costs capital, and we make mistakes along the way. But we want our customers to know that we're here for the long haul. We're not just they have to, a company they're going to take a flyer on and look around tomorrow and see that we're gone. So we want to prove longevity in the space. We want to accelerate our product roadmap, accelerate our business, and continue to scale. And that's really the reason behind the capital. If I could have done everything I'm doing today at the speed of which we're doing it and the quality without raising a dime, boy, I would. But our investors have also been, incredibly supportive, incredibly helpful, and have really opened doors for us as well. So, it's a cool milestone for sure. But we try to focus on making sure revenue and EBITDA are the core drivers, and our NPS and customer retention. Like, that's the real health of any business, agnostic of the fundraising.
Yeah, and I know that, as far as I understood, you spend a portion of that investment on acquisitions, including Laundromat, which brought like hardware into your ecosystem, right? So from your perspective, do you think that this combination of software and hardware is becoming more attractive to investors compared to this pure software companies. What is your opinion on this?
Yeah, I mean, I was talking to a founder friend of mine yesterday. He's got a really large business that's anchored in hardware, and we were both talking about how it's a little confusing sometimes for me why some investors have such an aversion to hardware. I understand it from the capacity where in many cases hardware can be a real margin drag on a business. It's very complex. It's very challenging to run efficiently. And, people love the high margin recurring revenue. And so I think that hardware can play a huge role, particularly for vertical SaaS businesses. But hardware can play a huge role if the margin profile is right and if the strategy around it is right. And so for us, we're able to sell pretty high margin hardware that really anchors our business to a customer, because once we provide a really good product that has, really strong reliability and is accessible from a price standpoint to customers, the churn is almost zero. And so when customers buy that product from us, we're also kind of selling a really deep retention tool for our business, where we get to then layer on more of our services from a software perspective over time, because it's all about value. When our hardware is powering your equipment, the value of our software that we can deliver to you is increases dramatically from what you can get as a business owner from an ROI perspective. The unification of your data, to be able to control your machines from your POS and business management, to have all of that in one place is of a dramatic value increase, opposed to just having, Frankensteining your systems together. So having just hardware, is that the solution? I don't think so, to build the kind of business we want to build. When you can create an ecosystem of products that have high gross margin or contribution margin and can help you build strong unit economics, you need to make sure that it works on a unit economic level for your business. But if it does, it can deliver an outsized return on that inventory and capital and operating expenses in running that business, and what you can deliver to the operator in lifetime value and in product value as well. So I'm a firm believer in hardware, but I also know in building our own hardware business prior to the acquisition of LaundroWorks, it's hard. And it adds a lot of complexity, a lot more cash burn. The lead times are long. There's inventory risk. There's a lot of elements that make it really tough, and to move quickly like a SaaS company can. So that's where I think M&A can play a meaningful role in de-risking your execution and accelerating your roadmap growth.
But still, as far as I understood, you think that hardware-related sectors could see this resurgence, right? Especially with this integration of software and AI that we see right at this point, right?
Yeah, I think hardware, software-enabled hardware and hardware-enabled software, as you could kind of make them interchangeable to a certain extent, I think are huge, especially in the payment space. But if the hardware you're delivering is the gateway for you to provide value, you see a lot of businesses in the point of sale space or in anywhere else that are, people are giving away the hardware for free or selling it at cost, because once you have it, I can then deploy all the other pieces of value that can drive both value to you as my customer, but value in terms of lifetime value to my business on a recurring basis. We are just lucky that we get to have a profitable division of hardware that also enables that, versus many other companies that have to lose money and give things away for free to get their entry point.
Yeah, and I know that you're passionate about working in this unsexy industries, like boring businesses, right? And it's not always easy to raise funds for businesses that don't have the same flash as, say, this AI startup nowadays, right? So, in terms of your advice to other founders in maybe similar industries, similar sectors, how do you find investors for what some might consider a boring business, right? So what should they do, to find the right fit?
Yeah, look, I think you have to be over the top, not salesy or ingenuine, but you got to be passionate about what you're doing. It doesn't even matter what it is. If you have an actual core obsessive passion about it, and there's an opportunity, and you don't have just a good idea, but you actually have a good business. I think nowadays investors are realizing that, and many of the most sophisticated investors are not trend chasers. And the real institutions are not going off, or not exclusively at least. Everybody's going to want to play. Every big fund's going to want a leading AI play, an ML play. Everybody wants a leader in any market, and they're going to bet on those leaders because the markets are so large that you can have the 10th best company with a really great rate of return for your fund. But I think that the best investors are the ones that are not going after the trends. I mean, albeit definitely something that everybody needs to be aware of in crypto and Web3 and AI, et cetera. But they're going after great businesses that have a profile of strong cash flows and unit economics that have also a growth path. Because there are also a lot of great businesses that can throw off a lot of cash flow that aren't going to grow 100% year over year and have that capacity. It's more of like 20 to 30%. And that's still a great business, but it might not be of the profile for venture. And so you got to find the kind of investor that is going to be supportive of your profile of business in the long term. We believe we have a venture kind of growth profile and a venture growth opportunity. And that's why we've gone that direction. And I think the investors get behind what we're doing because they see the market opportunity. They see our lack of kind of institutional competition. They see our ability to execute, the customer commitment that we have, and the obsessiveness we have over this industry to be a market leader. And I think that's what really investors want at the end of the day. They want passionate teams that are solving real problems for real people in the real world, and they want category leaders. And if you can demonstrate that, whether you're creating software for roofers and garbage waste companies, or you're creating it for laundromats, it's the same as if you're doing it for enterprise grade communication systems and cloud-based security platforms. And, I think that's the common theme, that at the end of the day, it doesn't really matter what you're doing so long as you have those kind of key pieces.
Right. And you mentioned that you made a couple of mistakes in terms of your fundraising journey, right? So looking back, what's maybe one mistake you made that you would avoid if you were to do it like again?
Well, it's hard picking just one because there are just so many of them. Okay. And so there's definitely not a few mistakes. There's definitely many, many more. I think, look, we had a unique fundraise because historically we had never ever went out financing. We always were preempted. We always had investors inbound. And in our Series B, we had that, but we were also tying it with an acquisition. And so I think that was sometimes part of it, where we might not have raised a Series B if we didn't buy a company because we didn't have a direct need to do so. But that was kind of part of the strategy. So I think, there were a lot of lessons I had learned over time about telling that kind of cohesive story, and that's going to get the right profile of investor for us. So I think spending more time on not just being excited about this massive opportunity that I could see. I felt like my team and I really saw what we were doing and could, and it was a no-brainer for us. It was such a natural move to go in this direction, where it became frustrating at times for me, where I was like, man, I wish other people could see what I'm seeing. And the lesson in there is, well, they can if we were actually thinking more critically about what that investor is looking for and what are the boxes they're trying to check for their fund and their performance of companies and their profile. So I think kind of not trying to oversell an opportunity because I'm so excited about it, but more relying on data and numbers and presenting like a full picture of risks, of positives, and then having that kind of genuine conversation with an investor of kind of all cards on the table, opposed to selling, is something that in the early days I think was meaningful and sometimes hard to get out of my own way, just because I did have so much excitement for it and in the opportunity, and wanted to move quickly on it, versus more of a deliberate process and thinking more critically in that way. I mean, that's probably one of the very many things I learned along the way, but.
Got it. And probably my last question: what are as 3 pieces of advice would you give to founders looking to raise funds in 2024?
In 2024 and heading into 2025, I think that the market's improving. There's a lot of dry powder, a lot of dollars that want to be invested in great companies. I think being putting a strategy behind your growth, I think is really important. In the early days, it was, okay, we're here now. We want to add this many locations in next year, and want to add this many locations next year because more locations in our business is more revenue, opposed to thinking in the different areas of growth of where we're going to actually embed ourselves deeper with our customers and make more money from our existing base. And so, I think that building the strategy along with the fundraise a little bit more than just, man, I'm running out of capital, I need to just go out and raise. Trying to put yourself in a position where every fundraise is your last, and presenting that model, I think, is investors love to see that they're the last check that you need versus maybe the last check that you want or get. So I think building that, I think at the end of the day, a good business is a good business, and you want to put yourself in a position where don't get lost on the headcount vanity. Some of the best companies that I know of that are at close to 100 million of revenue have cut their thoughts on what they need from a headcount perspective by 50%. So I think don't get lost on the vanity metrics of what you think you need to do in order to hit a certain threshold, and focus more on the execution and the quality of that execution, and the margin profile of that execution is what investors are excited about. They don't want to think, depending on your vertical, depending on your market, depending on your required cost outlays. But I think there have been a lot of stories of companies that have had a lot of success over a 10-year period by hiring like crazy. But an investor today is looking a lot more for an efficiency business that can also maintain growth. So presenting that story of efficiency is I think meaningful, and that's tied into a more strategic view on your future planning and growth. And I think the last thing I'd say is, like, investors can smell bullshit always. No matter how much you try to cover it, they're always going to smell bullshit. And at the end of the day, if you get an investor excited, once it goes into diligence, they're going to see everything. And so going into these meetings, go into your pitches with a warts and all approach, where you're telling the good, bad, and the ugly. And I mean, I'd get on the phone with some investors and I said, I know you reached out to me. I'm going to give you every reason not to invest in this business, to not want to. And if we get out of this call, you still want to, well, then we're going to have some fun. Because, being upfront and honest with what the business looks like, what are your concerns, what keeps you up at night, and not trying to just sell some rosy picture will get you a lot further and save you a lot of time.
Alex, thank you so much for sharing your journey with us. Any last thoughts or maybe exciting plans for Sense in the future?
I mean, our exciting things for us is we're profitable now and have some huge product roadmap items that we've been building for a long time that we're really excited to launch next year. I think that we feel like we have a pretty great opportunity in front of us. And I'd say for those listening, if you know anybody who is looking to get in the laundry business, buy laundromats, dry cleaners, or in that space, we always love to connect with folks who are interested in it. You'd be surprised. I have tech executives, private equity folks, celebrities, all the people you can imagine as customers of ours. And if you're ever interested in the laundromat business, the laundry business overall, always love to chat with you, and definitely be on the lookout for some more exciting, big news that we have coming in even early 2025. So, but thank you so much for having me. And, this was a lot of fun.
Yeah. Thank you very much.